Actors, videographers, photographers, tattoo artists, forget everything you know about taxes. Washington just rewrote it. Done right, you get to keep more out of every invoice. Done wrong, you're donating money to the government. Let's break it down. Your creative genius deserves the same precision behind the numbers.
Welcome to Let's Get Fiscal, hosted by Anastasia, Maisha, and Danielle.
Part of the women-led team at Coterie Tax.
From smart tax moves to cash flow strategy, we decode everything it takes to run a thriving, creative business
so you can scale with confidence and sleep easy at night.
Press play and let's grow your business. So taxes have changed again, which is so nice right after you get really comfortable with what it was before. Yes.
Right.
So there is now the One Big Beautiful Bill Act of 2025. And yes, it is a mouthful. So let's break that down. What are some of the changes that are coming through with that?
We have quite a bit, but a lot of it had to be done regardless. So the last time that we had the same administration, they also changed taxes pretty significantly. And it was wildly different from how they were doing, how taxes were done before.
Right.
And all of those provisions were set to expire at the end of the year. So no matter what administration was going to be in the White House and in Congress, changes were going to happen. And
Gotcha.
either the administration was going to help make those changes and Congress, something would go through Congress, or all of the previous changes, the Tax Cuts and Jobs Act of 2017 was going to expire. So regardless, we are facing a situation where the next few years, there's going to be a bunch of changes. So we need to go backwards and readjust what our tax strategy is to account for some of those changes. So luckily, a lot of the bigger items and the things that we really liked are still going to be staying in.
Well, that's good. Yeah, we love that.
And they've made a lot of changes, and a lot of them are really going to benefit the small business owners. And because small businesses are really the backbone of the United States, if these provisions had expired, it would have had a really detrimental effect on small business owners because it could have easily increased taxes by tens of thousands of dollars. And even for smaller businesses where you're not making any money, you still would have seen significant increases in your taxes at that point in time. So that's why I say in this situation, however you feel about the administration and Congress, their hand was kind of forced in this scenario. So it is this part of the bill is really good and is really going to be helpful. So making sure that we're identifying what the changes are and that you're taking advantage of them because we were kind of in that limbo of what's going to happen, what's going to go away, how should we make changes, all of that fun stuff. Now we know exactly what's going to happen and we can make those actionable changes on that.
Yeah, like adjust the strategies as needed or make sure that you still fit in with those strategies. Yeah,
right.
Okay, exactly. That makes sense.
Exactly.
So what's like one of the bigger ones of changes from like prior years to now?
I think the big one is going to be that bonus depreciation is back at 100%.
Oh, okay.
So bonus depreciation is when you buy a piece of equipment, you are able to expense the full purchase price in the year that you buy it.
Yeah.
And so in previous years, we had bonus depreciation at 100%, but it's been decreasing.
Yeah.
And then this would be, would be one of the final years. So now it's back at 100%, which is great.
Awesome. Yeah.
As a small business owner, you may not have noticed it because Section 179 is still available.
Yeah.
So you can still expense gear in that first year when you purchase it, but Section 179 won't allow you to have a loss.
Gotcha. Yeah.
Versus under bonus depreciation, you can have the loss, and then that loss from the company can offset some of the other income. So where this really comes into play is that short-term rental strategy.
Okay, yeah.
Because then you can do your cost segregation, you can accelerate the depreciation pretty significantly, claim 100% bonus depreciation, and then offset your income from your S corporation and your primary income driver. So having 100% bonus depreciation is really great, but it brings into light one of the weird things about the bill.
Okay.
Is that, so it was signed in July, but some of the changes they've backdated.
Okay.
To the beginning of the year.
Okay.
So some changes will go back to the beginning of the year. Some changes will be in effect in 2026. So you really have to be careful about these changes. And bonus depreciation is one of those where it starts at 100% on January 19th.
Oh, so not January 1st, 2020. Well, you can like do the whole year.
Yeah. They did some funny things because,
With dates?
inauguration day was, around that time. So they wanted to align some of these good things.
Okay. So if you had purchased anything from January 1st to January 18th, it wouldn't be you couldn't get that 100% bonus depreciation. Okay. Okay.
Yeah.
Okay,
You would get a
2 weeks. Maybe not so bad.
Right. You can still do Section 179. One of the things, too, to be really careful about with depreciation is you want to be buying your gear evenly throughout the year, or at least don't buy everything in the last 3 months of the year.
Okay.
So that's just one of the kind of key things with depreciation, because normally in that first year, it doesn't necessarily matter with if you're going to be taking 100% of the depreciation, but if you buy your gear evenly throughout the year, then you can get like a full year's worth of depreciation, even if you bought it in December.
Gotcha.
But once you buy all of your gear only at the end of the year, then they start doing it where you get like only a quarter, and they're taking a look at when you've actually made those purchases.
Gotcha. Okay.
So even though we have bonus depreciation, you want to take a look at kind of what your needs are and what your spending looks like. So you don't want to, if you want to go out and do a lot of those purchases, you should probably do it now before that fourth quarter starts, because the IRS knows what you're doing if you buy everything December 31st.
That's fair.
So they do have a few provisions in there to prevent everyone from
doing that. I got you. Okay.
Just spending $1 million on the last day of the year, and
Gotcha.
Yep.
Okay, cool.
So, but that bonus depreciation coming back, like I said, it really gives us a lot of options when it comes to all of these other investment vehicles that we can use to offset that primary income driver. So we love that. Also, one of the bigger things is the deduction for the state and local income taxes has increased. So instead of it being $10,000, it's going to go up to $40,000.
Oh, okay.
So especially in states like California or in New York City, but where your property taxes are pretty significant. In a lot of cases, your property taxes were already getting you to that $10,000 limit before you even started adding the
rest of the stuff.
Right.
Yeah.
And the standard deduction is supposed to be like, okay, this is the minimum amount of money that I need to spend in order to survive this life.
Yeah.
And so that's why they give you the deduction for those state and local taxes. So there was a lot of like living expenses that would be normal living expenses that were no longer tax deductible. So you were paying income tax on these basic necessities of your life.
Yeah.
And really recognizing that, especially now in California, a starter home, you're probably going to be paying more than $10,000 in those income taxes, or property taxes. So increasing that up to $40,000 is really going to help, and it's going to be a really great planning tool for small business owners. And then with that, because you had the state and local income tax deduction being so low at the $10,000, that's where that pass-through entity tax kind of came into play, because it allowed business owners to be able to deduct more than that $10,000 that and get closer to what their actual basic necessities were. So now, even though the limit is up to $40,000, we are still able to keep the pass-through entity tax. And one of the fun things, too, is that Congress has actually kind of recognized that this is a thing.
Oh, okay.
So before, the limit was the $10,000. And so obviously the state's small business owners, which were really prevalent, they kind of, created this workaround. And so nobody really approved the workaround.
Oh.
They just said, okay, if you take these rules, yes, that is what it says, but they're not going to have an opinion on it.
Gotcha.
They were just like,
Okay.
oh,
I see what's happening. Okay.
I see what you're saying. And that was like basically the answer to the pass-through entity tax. So there was a possibility that that whole idea would be challenged.
Gotcha. Okay.
Right. It was just, the IRS hadn't challenged it and was, not willing to fight the interpretation because they were like, okay, I mean, that sounds like a pretty sound idea.
Yeah.
So now that Congress has actually kind of written it in and acknowledged it, and that gives it a little bit more validity versus, I mean, initially in those first couple of years, I know some tax preparers that didn't want to do it
just in case.
Because they were like, I mean, nobody has said no, but nobody has said yes either. So, and the IRS does penalize you because if you understate your tax liability by a certain amount, they'll penalize you. So even if you went backwards and you paid the tax because they decided later that they're not going to agree with it, then you would still have to pay the missing tax and then also pay a penalty for understating your tax originally. So now enough states have gotten behind it. And a lot of tax preparers are using it as a tax strategy. So it's more mainstream, which is great. But like I said, also having Congress recognize it is really good. So it kind of shows that that's going to be here for a fairly long time. And that has also stayed in place.
Okay.
Which I love. So the pass-through entity tax, it allows the business to pay the state income tax that its profit creates on your tax return.
Yes.
On your personal return. And then because the business is paying for it, it's not required to pay for it. You get to take it as a federal tax deduction. And what that means is instead of it going towards your standard deduction and you're itemizing and you're taking $40,000 off of your return as an itemized deduction, now you can take those $40,000, claim it as a federal business tax deduction, but you still have your $20,000 standard deduction. So now you're taking $60,000 as a deduction off your federal tax return.
Pretty good strategy.
So, right. So even though a lot of people have said, okay, well now the $40,000, it's above what my property taxes would be. It's above what my state and local income taxes would be. Do I still need to do the pass-through entity tax? And my recommendation is yes, because it allows you to get the benefits of itemizing, but also keeping your standard deduction intact. So you're kind of able to double dip a little bit there. But the only caveat is Congress has recognized that you kind of get to double dip. So they have added in a little bit of a safeguard.
Okay.
So you have to make sure that you're recalculating, because if your pass-through entity tax payment is more than 102% of what you actually owe the state in taxes, then you no longer get the federal tax deduction.
Okay, so they've capped it. Okay.
Right. So I guess that's kind of, they've recognized it, but in recognizing it, they've also created guardrails where before they didn't really recognize it. It was just kind of a thing that was happening that had gotten so much momentum, but it didn't really have any rules based around it because it wasn't really
acknowledged that this is a real thing to do. Yeah. Okay.
So now they've kind of acknowledged it. There are still a few states that don't have the pass-through entity tax that I would think are probably going to be
instating it soon. Okay.
Because in a lot of cases, it's a good way for the entities to be able to get a little bit more cash sooner. So for example, in California, your pass-through entity tax is 9.3%, which is one of the highest tax brackets in that state. But if you are in a tax bracket that's lower, it doesn't matter. You still have to pay the 9.3%. And then you get the credit, and the credit carries forward to multiple years. So maybe maybe you're paying 2 years worth of state income taxes in 1 year, which means the state gets their hands on it a little bit sooner.
Gotcha. Okay. So it does benefit the state as well. They get a little bit more like cash.
Right.
I got
exactly.
you. Okay.
Exactly. So all of these states that were kind of on the fence a little bit and waiting to see what would happen, I would think that they're going to get something.
There's more upside. Okay.
So, but it does mean that it makes it a little bit trickier for a business owner, especially somebody who owns multiple entities or is married to someone who has their own business.
Yeah.
It's going to
being careful of that cap and making sure they don't hit that cap. I got you. Okay. Okay.
A little bit more planning around that. So versus before, it was just, like a nice, easy calculation, and then you just walked away from it.
Yeah. Yeah. Okay.
So we have that coming into play. Another thing that stayed around was the QBI.
Okay.
So qualified business income deduction.
Okay.
So a lot of times nobody really notices it. So if you look on the first page of your tax return, you have the section where it says your standard deduction. And then right below it, when you have like a single member LLC or S corporation or a partnership, you would see another number down below that.
Okay.
So basically what they do is they take whatever your profit is from your business, as long as it's not a corporation, anything other than a corporation, and you get a 20% business deduction kind of right off the top.
Oh, okay.
And so that was because corporations went to the flat 21%.
Gotcha, yeah.
So to kind of still incentivize some of these other business structures, they're allowing them to get an additional 20% deduction to kind of even that playing field.
I got you.
But that was all about to expire completely. So you think a business that makes $100,000 and a business owner in, like a 25% tax bracket, that's, like an additional $25,000 deduction that they just immediately lost. So being able to keep that is a really, really big deal.
For sure.
So, and then I believe that that's going to be made permanent, so we don't have to worry about that kind of getting
expiring
removed.
Again. Okay.
Right. And one of the problems with that is when you give someone such a large deduction, yes, it does give business owners more capital and ability to expand their business, but then you have kind of like lifestyle creep.
Yeah.
So when you're getting a deduction that's enough to pay for, like a part-time person, rent for your office, it's really hard to 1 year be like, oh, okay, well
now I don't have this.
Right.
Yeah.
Right.
Yeah.
Exactly.
Okay. That's fair.
Exactly. So being able to keep that is a very big deal. So, we already have a couple of different things that are helping keep taxes low for those small business owners. And just making sure that they're able to continue growing and even surviving, because it's been a lot of years of recovery where everybody keeps saying, it's going to be different this year and it's going to be different that year.
Yeah.
But something always happens. So we just need a little bit more time for that recovery phase. So if taxes increase, like I said, if you have an extra
you're definitely in an interesting timeline. Okay, cool.
So, and then another thing, one of the things that's going to expire is the electric vehicle tax credit. So because obviously the electric vehicle tax credit is built to incentivize people to purchase electric vehicles, but that whole industry has become a little bit more diversified. And one of them is too large, and so they don't need that tax credit to help with their sales anymore.
So it's just going to go for
some
everybody?
of the other new people.
Okay.
Right. Yeah, because if you have some of these newer companies that are still in development and, releasing new vehicles and all of that fun stuff, missing out on that $7,500 tax credit, which is like a huge marketing and appeal to a lot of people, we'll see how that
changes now that that's phasing out. Okay.
But one of the big things was, so for example, a Rivian, it's a large truck. It's over the 6,000 pounds. It doesn't get the full $7,500 tax credit because its base model is too expensive, but you still get a portion of it, 3,750 to be exact.
Okay, yeah, to be real exact, yeah.
So if you want to take advantage of the tax credit and then also be able to take advantage of the, 100% depreciation because it's that oversized vehicle, you're going to have to place the order before September, before the end of September.
Oh, okay. So that's like a very, it's going to need to be done soon. If you're going to do it now. Okay.
Right. Exactly. And so a lot of it's placed on the order date, but you still have to make sure that the final manufacturing happened in the United States and some of those other things. So
more guardrails to make sure that you're checking off certain boxes.
And some of that was already in place. Okay. So they have like a website where you can check and see where your car
fun.
was.
Okay.
You can kind of see the life cycle of your vehicle because again, the tax credit was built to incentivize electric vehicle purchases, but then also to incentivize vehicle manufacturers to produce in the United States.
I got you. Yeah. No, that makes sense. Okay.
So that tax credit is going to go away. So if you are interested in buying a new vehicle and you want to take advantage of that tax credit,
do it before end of September.
Yep.
Okay.
And I assume we're probably going to see quite a few
of those. Yeah. Tax season will be interesting this upcoming year.
So, I mean, a lot of these changes, they may seem like they're a little bit small or a little bit nitpicky about it, but it really all comes down to timing and when you're going to time different things to happen to make sure that you're doing it in that tax advantaged way. Because like I said, if you know that you would like this vehicle, you need something larger so that you can put all of your gear into it.
Yeah.
Because I've seen sometimes it's difficult to get everything onto a plane and, you're bringing tools and all kinds of different crazy things. So, having to take that through the TSA or it's like specially packaged and really sensitive. So I know some people, it's easier for them, especially if it's only going to be like under 8 hours, it's easier for them to just drive.
Yeah.
So having a larger vehicle that's able to support that, or, we have some who they do film production, but it's all outdoors. So they're going to remote places. So they need like that Jeep that can go through all of the rocks because they're only doing productions for rock climbers and things like that. So if you're already thinking about making those upgrades, then you may want to move that timetable forward.
Do it a little bit earlier. Okay.
If that electric vehicle is a little bit more in line with
doing that. And then also making sure your tax strategy for like pass-through entity tax and stuff is kind of like going the right way so you don't hit that cap or you don't go over that cap basically. Right. Okay. Yeah.
Right. Exactly. Okay. Because it's one of those like really good situations where I got a lot of people that just say, okay, let's just get everything down as far as we can go. I have to say like, okay, hold on.
Yeah.
There's other pieces where if you drill down your income so far, then you start losing out on other things.
Yeah.
So especially if you're thinking about, okay, it's a great year for bonus depreciation, so I'm going to buy that first Airbnb.
Yeah.
That Airbnb is going to offset all of the income from my S corporation production company. Well, then that might not be a good year to do the pass-through entity tax because you're not going to be able to take the federal deduction. And you're going to be leaving, you have to pay the 9%. So you're giving California money that will get applied to your following year's taxes, which means that you just like now you don't have $10,000 in your bank account, earning interest. You've just given it away, a little bit earlier.
Yeah. No, that makes sense. So it's planning. It's making sure you have a good tax plan in place of like, if I want to do this, then maybe we don't do this, or let's do this, and then we push that one off or whatever. Yeah. Okay.
Right. And then also, especially with this bill, being aware of the different dates that things are changing because they've added a whole bunch of
no, that's good.
Stuff. So, I think from a tax perspective, this bill is really promising because again, something had to be done. And if everything expired, then it would have gone to the way taxes were in 2015 and 2016. And there's some people that have never, like, they never filed that type of tax return, you know? So you're just kind of like, okay, I finally started to get a handle of what was going on. And then now it's all going to completely change. And I know when Tax Cuts and Jobs Act first came out, a lot of tax preparers decided they didn't want to, like, it was so many changes, they just didn't want to do it. So they just decided to retire. So, you know, then we had COVID hit and, you know.
Interesting timeline. Again, very interesting. Yeah.
So if taxes had changed again really significantly, I think the accounting industry would have had another like big upheaval.
Everybody just throwing the table. I'm done.
Right. So I think it's difficult now to find a CPA. Just imagine if they changed everything.
Okay, so we got some pros. We got like not really cons, just more so just like more things to be aware of while doing the thing. So that's not too bad. Yeah. Okay.
So we've got a lot of different opportunities that are still available, but it's just making sure that you're actually layering that into your tax strategy and taking advantage of it while it's out there for you. So
that makes sense.
That's why it kind of highlights a tax professional. You know, anybody who's an enrolled agent or CPA has to spend 30 to 40 hours a year only focused on this particular subject. And that's at minimum. So having somebody who is actually taking the time, taking the classes and stopping everything and only looking at these individual pieces is really super helpful because you're going to get a lot of information. And even right now, there's so much stuff in the different news articles. And one of the difficulties is that the House made changes and then they sent it to the Senate and then the Senate made changes and then they sent it back to the House. And then, you know, so then you're like, well, which one is part of the final bill?
Yeah. What stuck? So
you have that. And then you also have, okay, this is what Congress wrote, but how is the IRS interpreting it and putting it into action?
Okay.
That also comes into play. So you just have to be a little bit more careful with some of these newer tax law pieces.
That's fair. Yeah.
Because, you'll find that a lot of the information just is contradictory because of the way that taxes are like more of a living, breathing thing.
Whole organism.
Right. Okay. So, just having that, like I said, especially before the end of this year, checking in with your tax professional, reviewing your strategy, making sure that you're acting on anything that you need to act on and you're identifying what's really super important to you. Before the end of the year. Don't wait until April. And then just keep in mind things are going to keep on changing from here. So,
but you can get some info from us.
So if you would like to learn a little bit more about this new bill and also how it might affect your specific situation, feel free to put a comment below or send us a message and we will get back to you.
Bye.
That's a wrap on Let's Get Fiscal.
Ready to stop guessing and start saving? Click the link in the show notes.
Grab your consult and let's make your business work for you,
not the other way around. You've got this.